Hi everyone, this is Sasha Hodler. You're on the Hodlcast, and today is September 4th. We're going to be looking at taxes for ICOs that are issued. We're just going to compare certain jurisdictions of where you can issue them and what the laws apply. So the first one I want to look at is Estonia. Estonia is always coming up for me with my clients as a good potential place to launch a project. They seem to have pretty nice regulations, so wanted to look at it from the tax perspective. And right away in the research, it came up that according to Ernst & Young, who did a big study, Estonia was ranked in the top 15 countries in the world for how much money they've generated on ICOs. So that was pretty, Estonia is the 157th largest country in the world. Its population is 1.3 million. So it's tiny. And here it is, bringing the 11th amount, greatest sum of ICO money. So the reason behind that is likely Estonia has an E-residency program. So it was the first to create this E-residency program for global citizens, and it offers companies the ability, like anyone, I could become an E-resident of Estonia by filling out some stuff online and going to the US or Canadian consulate and having them verify my documents. I would be able to open a company in Estonia without ever going there. And so it is pretty flexible. They actually, funny fact, Estonia won the Guinness Book of World Records in 2009 for being the fastest country for having the fastest time to open a company, and it only took 18 minutes. So they introduced, they're very innovative. They introduced the digital ID card so people can actually authenticate their identity instantly and sign documents and access public and private services entirely online. And but as great as the e-residency sounds, it's not tax residency. The e-residents, they only pay tax in Estonia if they've created something that's a company that basically legitimately is there under international tax laws. And so that's a whole other question of whether you qualify for their tax rates. And then in terms of ICO regulation, Estonia, it doesn't have any, it has never had, to my knowledge at least, any enforcement actions, but they are part of the European Union, and there is the Securities Market Act, there's Consumer Protection Act, there's Money Laundering and Terrorist Finance Prevention Acts, and there's what's called the Estonia Financial Supervisory Authority. So there are several regulatory bodies, just like in America. The main component for them, though, of being a security and then falling within that SMA regulation is that it has to be a tradable right to something. So that right can either be equity or a debt instrument, but it's very specific. Like, it has to give rights in something, which, as we know, tokens don't really necessarily give any rights to anything. If they're pure, utility type token, you don't get any right to that company's overall profits or that they owe you anything for having their token. There's no link there. That's kind of where tokens fall short. So in Estonia or all of Europe, falling under the securities requirement is different than the Howey analysis that in America that just requires an investment contract to create a security. A little more than that, but it's a more subjective test in America, and it's pretty clear cut. If you're not issuing dividends, if you're not giving them rights to your company, then they're not going to be a security. So most tokens do fall under the definition of a utility token in Estonia, and there's also the Swiss regulatory authority has gone ahead and defined a utility token. I don't have the definition handy, but it's something pretty broad that just says, what anyone would think a utility token is. It's something that gives you rights to, no rights, like it's just you own the token. The token is supposed to be used for some kind of, access. And then, so since there's really not been a lot of enforcement actions, Estonia has been seen as a pretty friendly jurisdiction to launch an ICO from. So then the next question, how are these issuers taxed? Many people get excited when they hear the headline, the first thing you Google about Estonia taxation is that it ranked first in 2017 for the International Tax Competitiveness Index. But that tax competitiveness index, it actually just measures, it's more like what's good for the government than what's good for the person. It measures the ability for a country to raise enough revenue to meet their government's priorities while still remaining competitive and promoting economic growth. So it doesn't measure the things that, an ICO issuer might be wanting to see. But short of that, there's also this thing called value-added tax in Europe and Estonia. And curiously and maybe wonderfully, Bitcoin doesn't fall into this value-added tax. So it's not subject to these income taxes. So those taxes are at a 20% rate. So it looks to me, and I really need to disclose, and I should have said it right at the beginning, I'm not a tax attorney. I'm dabbling in that area, and they always say that's a dangerous place to be, but I'm just curious about it, so trying to look it up and doing my best to interpret these tax situations on an international basis, but still pretty green in learning this stuff. So if I get something wrong, please forgive me. Don't rely on anything I'm saying here for your own projects. But anyway, this value-added tax, it typically is 20%. Estonia doesn't charge it on Bitcoins or ICOs. So it does make it one of the best countries to launch your ICO if you can fall under Estonia's taxes, which, as we're going to get to later, is difficult if you're an American. There's also a peculiar rule for corporate taxes in Estonia. The tax consequences shifted. So a company that earns income, you can earn the income today, but until you use that income, you're not going to actually pay tax on it. So it's different, like in America or Canada, when you earn the income, that's when the taxable event happens. In Estonia, it's deferred. You earn the income and then you pay the tax on the earned income at a future date when you use that income. So if you wanted to just, earn a bunch of income and never spend it, never use it, you wouldn't pay tax on it. Probably there's some, things, but if you could get that, when you're getting close to, time for your estate to pass, you could probably add someone to it. And anyway, I'm sure it's just a different way of doing it. And it looks to me to be more competitive than America. However, like I said earlier, in order to get E-residency is totally a separate issue than getting tax residency. So ICO issuers, they're probably going to have to pay the tax in their home country unless they're actually living in Estonia, based on these international tax rules. So the difference in tax consequences of launching a utility token versus a security token. Now, in most situations, you're, as an issuer, going to be better off launching a utility token. I mean, it's not legal, but it's way easier in every way to do it. It's not legal in America, in my opinion. I mean, some people would say it is based on the difference of the June 14th Hinman comments, but I'm still very cautious around doing any of this in America. But here's one aspect where, from a tax perspective, you're actually way better off doing a security token than a utility token, because the security token is considered selling equity, which gets it's not taxed. The company selling the ICO would just be selling equity shares, and that income coming in is not classified tax as income. But if you're selling utility tokens, it is. So say you raise $20 million, you're going to have to pay whatever your income tax rate is if you sold it as a utility token. And if you sold it as a security token, you don't have to pay any tax on it. So big difference there. And then the issuer. So in America, like if you're considering yourself a security token, like I just said, it's not taxed. But If it's income, it's the fair market value of the crypto received from the utility ICO. And there is a caveat for utility tokens if it's prepaid goods or services. So if the token actually represents an ability to acquire a good or service provided on the platform, then the company can actually defer their tax recognition until the following year. But then companies also have to be really aware of phantom income. And this is if companies are formed pursuant to an LLC or a corporation, then it's the entity that's responsible for the taxes, and those flow through to the owners in different ways depending on how the company is structured. But a lot of companies in this crypto space are forming as what they call themselves as DAOs, but really the court will, or any kind of regulation would see them as a partnership. Like if you're starting a business and you don't actually take the time to form a legal entity to be the business, then it's going to default to a partnership or a sole proprietorship in the eyes of the IRS. And then taxes would fall on the individuals personally as a pass-through nature. But in a partnership, each co-founder is responsible for the taxes in an equal share of the net income, regardless of whether he or she actually received any money from the partnership. So if someone is a de facto partner, they can end up having a larger bill than they can afford, and that's like known as phantom income. So be very, very cautious if you're trying to start these DAOs, or just don't do it. Unless you're Satoshi Nakamoto and you can really be anonymous with it. And then ICO income deductions. So spending the ICO revenue on tax deductible expenses is, a way to write off some of your tax implications. So things like salaries, all the basics, salaries, office rent, equipment, marketing, which I think brings up an interesting question. If you're giving out airdrop bounty tokens, can those be considered as a marketing expense? And then can you calculate the whole value of whatever you airdropped against your income? I would argue yes, but again, I'm new to the tax space, and there might be some pretty more experienced tax attorneys that would laugh at that proposition. So I don't know the right answer there, but in my head, it would make sense. If you can write off marketing, you could write off your airdrop bounties. You can write off your advertising, your travel, any conference fees, bank fees, your cell phones, your discounts to customers. Here's another one that I think is an interesting question in the ICO world. So if you're selling discounted tokens, is that a discount that you're giving to customers? And is that difference of what you sold at a discount in your pre-sale or whatever, can you write that difference off on the tax year, which that would be a huge number. Say you sold all your tokens at 50 cents in a pre-sale, and then the real price at your ICO price was $1. Well, is that whole 50 cents, depending the number of tokens you sold at the pre-sale, could be pretty big tax consequence there if you really could write that off as a discount given to customers, which I don't see why you wouldn't be able to. But back to that same caveat, I'm just learning this right now. Also, you can write off your family members' wages. Another funny one, you can write off your guard dog. And that includes your vet bills, your, food costs for the dogs. But I looked that one up. It has to be a dog that actually serves as a guard dog purpose. So it has to be like a Doberman or German Shepherd. Like there's certain breeds that you can write off. And then you have your gym membership. For employees, you can write off health insurance, home office, legal fees, research, development, taxes incurred in running your business, which that's funny. You can write off your taxes for tax purposes. You can write off theft and loss. And that one in the crypto space, like if you get hacked or you lose your Bitcoin, that's something that happens like pretty frequently. So I wonder how they, qualify that. Everything else says you need to keep receipts. Well, how do you prove you lost your Bitcoin? But it's, that's a question we'll probably figure out over time. There'll probably have to be some court cases on it to actually figure out the right strategy to do that. But it is a tax write-off if you lose your Bitcoin, apparently. It just says theft and loss. The cost of your website design, and several other things that you can write off. But all of this can reduce your ICO income tax. And also note, if you're using these deductions, you really have to keep good records. So keep your receipts on everything, keep them organized. This is something, in my little law firm here, I can write off a lot of expenses like my home office or parking sometimes, travel, going to conferences, all those expenses I can write off on the taxes at the end of the year, but I am awful at keeping everything organized. So all I do is just take my receipts. I hate having extra paper in my, wallet. I don't like anything bulky. I'm a real minimalist of what is in my purse, but I'll write on the back of the receipt just what, parking at whatever place, March, and then I put in an envelope in this box for my March receipt. It's gonna be a nightmare at the end of the year, but it's at least I have them and they're somewhat, in envelopes according to month. There's probably a way better way to do that, but anyway. So then I looked a little bit at offshore tax havens and how they work. So some companies have been launching utility tokens from these offshore havens like the Cayman Islands. And the rules to get the tax haven are really quite complicated to navigate. For example, the ICO issuer that registered in the Cayman but lives in the United States and sells their ICOs to Americans would not qualify because they live in America and they're selling to Americans. They're going to pay taxes in America. Foreign corporations can't be engaged in business activity that is effectively connected to the United States to avoid United States taxes. I'm getting eaten alive by mosquitoes right now. Basically, if the revenues derived from assets that are used and held in the United States and the activities of the United States business was a material factor in realizing the income, that's the test for whether or not it's effectively connected. And then you have the controlled foreign corporation test. So if a foreign company is owned by more than 50% US shareholders, it's called a controlled foreign corporation for federal income tax purposes, and CFCs are the abbreviated term, and they're subject to a complex set of rules designed to prevent tax avoidance. And US shareholders, they have to pay certain income tax on certain types of income, which might include the proceeds of an ICO depending on the circumstances. And if you have signing authority on a bank account that's belonging to a foreign corporation, you have to disclose that account to the IRS by filing an FBAR. And this is where things, I don't want to be one of those attorneys that just spread a bunch of fear out there. But when I read up on these FBARs, it's pretty serious if you don't file it. If the account balance is over $10,000 at any time during the year, you have to file this FBAR. And the penalties are a fine of $250,000 and 5 years in prison. I have no idea how often these things are actually getting enforced. That punishment seems insane to me, but that's what's on the books. And so security tokens, they should be, oh my gosh, these bugs, sorry. They should be treated differently than utility tokens. So if it's sold pursuant to a Regulation D or any other exemption from registration through the SEC, then it shouldn't result in a situation where the revenue generated creates any income tax. But there's a nuanced position because the IRS code exempts equity sales from being characterized as income tax or income for tax purposes. But equity typically means an instrument that has rights to distribute. So they're either giving you a right to share in the profits or some kind of debt or voting rights. So I think security tokens, like the ones I've launched for people using Regulation D, they operate essentially the same as regular ICO tokens. They are not giving people the right to anything in the company. But I think in order to qualify for the tax purposes, we're going to have to go back and look through that and make sure that they're are some kind of voting rights so that we would fall into the equity category. It would be a shame to go through all of the extra labor to launch a SEC compliant security token and only sell it to accredited investors, so completely limit your audience or funding. Basically, you're going to get a lot less if you're doing this route, and there's no liquidity right now. So you take all these steps just to comply with the SEC, and then shoot, you end up having to pay taxes as if you did it the other way too. That would really suck. So you got to make sure there's some kind of voting rights or some kind of equity connection when you're selling Reg D security tokens. And likewise, the tokens that are representing debt, they're not taxable to an issuer. And I think that's what SAFTs fall under. Like a SAFT where the investor pays a set amount of either crypto or fiat up front for the right to get a certain number of tokens at a later date, that should be treated like a debt instrument for the issuer and like a forward contract for the investor. So they should tax it as a forward, meaning they can defer it. So the investor can defer taxes until the tokens are actually issued. And once the issued, the price should be considered at the cost basis of what the price is on the day that the thing is issued. So they actually get like a little break in their taxes. So they're not paying, say they bought the tokens for $1, and by the time that the whole marketplace launch takes place, like maybe a year later when they get their tokens that are, if they were locked up pursuant to Rule 144, and the price is now, in an ideal world, the price has not gone to zero, instead it's gone to $2. The forward contract tax basis is that $2. So that person got a free dollar from their tax side, if that makes any sense. So they're not going to get taxed on their discounted price as the cost basis. And then the next question, what about foundations? That seems to be like a pretty common way that these projects are launching. If you look, Ethereum did it, EOS did it. And a foundation is a good option for a utility ICO because they can register as there for tax purposes. But I don't think it would be permissible. Well, I know it's not permissible to launch a security token from a foundation because the foundation neither has owners or shareholders. So there'd be nobody to write like the Form D if you're going to sell Regulation D tokens to the SEC. And a foundation has to be established for a not-for-profit entity with beneficiaries for the fulfillment of a specific purpose. And to me, the ICOs from a foundation, it might have worked great in 2014, but I think we've matured as an industry past being able to call these things not profits. It's clearly a profit-seeking endeavor to do an ICO in my mind. Now, if you don't care about selling to Americans or Australians or China or now I think India is on the list, South Korea. There's about 12 countries, the big ones, that you can't sell to. So basically, if you only want to sell to European and a few other places in Africa, you can do this. Like this is okay if you're not coming to America, but I think it is also kind of like admitting that you're a security because you're staying out of American jurisdiction. Like that you kind of are a security, so that's why you're not risking it to come into America. So then it's going to be hard to get yourself listed on an exchange that's not allowed selling securities such as Bittrex or Binance. So, but it's happening. I mean, look, EOS is on the exchanges, so it's, it is possible. So if you're doing these foundations, Nevis is a particularly compelling jurisdiction. It's got a tax-free jurisdiction, and it offers this multi-form foundation, which companies, you can have a company foundation, a trust foundation, partnership, or an ordinary Nevis foundation. And it can also, it can own any form of property or conduct business or trade or commerce or commercial activities. So this foundation doesn't have to be limited just to, charity work. And it's one of the most flexible structures worldwide, but it's, again, like if you're 50% owned by Americans and you're selling back to Americans, you're going to be that CFC thing again. So you're still going to be stuck with your American tax laws. You wouldn't get the tax-free status in Nevis unless you actually go live there for 183 days of the year. which, Nevis or Cayman, those places, I don't think it'd be a bad place to live for 183 days if you stand to make a ton of money. Now, we're almost done, thank God, because I think I've got like 50 bug bites just doing this. But okay, equity crowdfunding, so Reg D. For investors, like the tax treatment for these follow the same general rules as stock purchases under Section 351. So as long as the security token would qualify under 351, the investor won't recognize any gain or loss until making the initial investment, and the cost basis will be set at the token price launch. So gains or losses are reported on your Form 1040, and as we know, losses of up to $3,000 for the investor can be deducted against the ordinary income. Now, this is where it gets exciting, or I got really excited when I read the research, but then I found out Trump changed it in January 2018. So my research I was reading was old, but I came across this Internal Revenue Code Section 1202, known as the qualified small business stock. And this provision allows investors to minimize or eliminate tax on successful exits in qualifying companies. The provision came into effect in '93 with the goal of incentivizing investment in startups and rewarding investors for the risk. And companies that they invest in have to be worth less than $50 million, which most ICO companies, I think, can be valued at less than $50 million at their launch. And the stock, I think security tokens hopefully fall under that category, must be purchased directly from the corporation. So ta-da, that's what an ICO is. You're buying it directly from the corporation, and it has to be held for 5 years or longer. So you got to have those strong hands. But if those three things are met, the company, the company can't be in the business of finance, service, mining, extraction of resources, restaurants or hospitalities, and there's some restrictions on real estate. So it doesn't say anything about technology, so I think crypto would apply. The amount of the gain can be excluded for up to 10 times the investments or $10 million. So that's huge. Like if you hold your ICO security token for 5 years from the time that you buy it, you're not going to have to pay tax on it. So that was the '93 rule. Then in 2014, it got reduced to 50%. And then now apparently it's 0%. But if anyone did buy an ICO in 2017 through a security token, so if you were an accredited investor, you bought it pursuant to Reg D, Reg A+, or Regulation CF, you got to look into this, because you might not, if you can hold on for 5 years, which I know is like, dog years in crypto, 5 years is a long time. But if you do that, you probably don't have to pay any tax on it, the way I understand this 1202. So check it out. It's kind of like what we learned and then you can roll it into another qualified investment. Well, you could before. Now that they're not qualified, I don't know. But it was kind of like the idea behind like-kind exchanges that everyone thought we had. Well, that kind of was the actual situation for equities in these small companies. So in conclusion here, I think generally, if you're trying to sell to American investors and you live in America, there's no value that I can see in forming outside of America. You're still going to end up paying American tax law and subject to American SEC jurisdiction, as well as the AML KYC requirements through FinCEN. So, gosh, sorry, these bugs are like attacking. Anyway, okay, so yeah, if you're an American selling to Americans, doesn't matter where you form, you got to deal with American law. Kind of makes sense. So I think if you're dealing with American law, you'd be prudent to go the Regulation D route, and that does offer, finally, we have some reason to do Regulation D, and that is taxes, because as long as you have something that's of equity, like if voting rights or you're actually giving dividends or something like that to your investors, all the things that we try and stay away from, if you're selling a utility token, well, you want to do something like that in a Reg D security token so that you can get qualified as selling equity, and then your investors don't have to pay any taxes on their capital, or sorry, the investors still have to pay tax on their capital gain unless they can find some loopholes, but you as a company get to keep the equity tax-free. So you don't need to go to Nevis or Estonia, is my conclusion here. Thank you, and if you have any questions, please feel free to comment, and also feel free to subscribe to my YouTube channel. It's kind of light in the subscriptions, so would love to get a few more subscribers there. Doesn't really matter though, but yeah. Okay. Thank you, and have a great night. Bye.